Thinking of it, baby, I was wrong. Hi everyone, and welcome to today's webinar. For those that don't know me, my name is Paul Bates and I'm the National Sales Director across the media team here at the REA Group. First and foremost, I just want to send my best wishes to each and every one of you. I hope you're all remaining safe and well, and also pass that to your families. Today's webinar is a series of webinars that we're running to really provide you, the market, our key customers, with key information on the economic impact that no doubt we're all seeing through COVID-19. And today we're very lucky to have Cameron Cusher with us. Cameron is one of the leading economists at the REA Group. And today Cameron's really going to take you through some of the impacts we're seeing relating to the economy, both locally and internationally, as well as sharing with you some of those key data insights that we're seeing within the property market, obviously as the market leading portal in this space. So there will be a chance for Q&A. You can see at the bottom of your screens down here, you can enter in some questions as we go or wait at the end. But for now, I'll bid you farewell and hand to Cameron to take you through the presentation, and I'll see you back shortly for some Q&A. So thanks for now. Over to you, Cam.
Thank you very much, Paul, and thanks everyone again for coming today. So I think the good news in terms of what we're seeing with COVID-19 at the moment is that things have slowed down a little bit. The first couple of weeks, there was so much information coming out, so much uncertainty, and there's still a lot of uncertainty, but I guess the rush of information has really slowed, but there's certainly some impacts that we're seeing on the economy, and the housing market is certainly impacted by that as well. But I think immediately, if we look at the areas that are really heavily impacted, the tourism sector has essentially shut down. I mean, we've closed our borders, so international tourists can't come in, but a lot of states have closed their borders as well. So you can't even go interstate and go for a holiday at the moment. We're all being told to stay in our postcode, so that's really impacting on that sector. A flow-on of that shutdown of the borders is the higher education sector. Our universities have become very reliant on overseas students, particularly from China, and because we have closed those borders, a lot of overseas students haven't been able to come back for the first term. And I guess at the moment, there's a bit of uncertainty as to when we will open back up those international borders as well. And in the retail sector has been hit particularly hard. If you think of the places that simply can't open anymore, you've got gyms, yoga studios, that kind of thing. A lot of retailers have actually closed their doors, places like Myer and David Jones for a period of time. And then you've got the restaurants, cafes, pubs. Well, pubs have had to close, but restaurants, cafes, they've can only do takeaway meals now as well. So they've been very hard hit by the COVID-19 crisis. I guess the main crux of the issue, though, is that the economy is not able to function as it has in the past because so many businesses have been shut down and so many staff are working from home, and a lot of staff have been either stood down or laid off from their jobs. So if we look at this economic downturn compared to other economic downturns we've had, it's very different in that simply parts of the economy simply can't operate. Even if you went all the way back to 1991 recession, businesses went out of business, people lost their jobs, but people could still go to the pub and have a beer with their friends. They could still go out to the restaurant and have a meal if they wanted to. We don't have those options open to us now. As I said, many employees have been stood down rather than dismissed. And I think a lot of businesses know that once this is all over, they're going to need those people back. So there is a reluctance to get rid of them completely. Plus, there's some incentives in place now for them to not get rid of them completely. But I think the crux of the issue is that just business and consumer sentiment is so weak. And it's because there's just so many unknowns. We don't know if we're going to get sick. We don't know if we're going to recover well if we do get sick. A lot of people don't know if they're going to still have a job in a few months' time. They don't know what the impact's going to be on their business. So this is just this huge amount of uncertainty, and that's really playing on people's minds. And then if we look specifically at the real estate sector, you've got open homes and auctions are now banned. So I guess real estate is lucky that it can still operate in one form or another. But it is difficult because it's not the same conditions that real estate typically operates under. But the industry is evolving and innovating to get its way through that. In terms of some good news, the Chinese economy is starting up again, going back to work. We're also seeing a few economies in Europe starting to let people back to work. So I think that would be a good litmus test for what we might look like here in Australia in the coming weeks and months if we start to open things back up again. I think it's good that we're not the first ones to be doing that. We've also got an unprecedented volume of economic stimulus that's in place now. So that is going to carry us through this period, hopefully, but it will also take some time to be wound out once we get past COVID-19. And then the Australian dollar's weakened, assuming it remains weak, that's going to provide a lot of assistance to the export sector.
Hey, Cameron, sorry just to interject there, but just wanted to check, I'm not seeing your slides. If you have slides, if you could share those on screen also. Thank you.
My share screen didn't work properly, sorry about that. So luckily we're running on the first slide, but if we look at the next slide now, what does the world look like post COVID-19? I think the important thing is there's the potential there for the downturn to be relatively short. The pace of the rebound is going to be very important though. I think, again, real estate's kind of lucky that it was already operating, is still able to operate through this. But some businesses, unfortunately, are just not going to be able to come back. We hope that everyone can come back, but the side effect of a recession is that at times the businesses won't come back. And a recession is ultimately looking pretty inevitable. The government assistance package is going to cushion how tough those conditions get and limit the job losses, but economic growth is going to be trimmed significantly because so much of the economy just can't operate anymore. As I said earlier, we've got high levels of stimulus globally, and that should lead to a fast recovery. The cost of borrowing for individuals and businesses is low, and it's expected to remain low for some time. And I'll talk about this later, but I think that means once we get past COVID-19, there's some pretty tantalizing interest rates out there for people borrowing or businesses looking to borrow and grow their business. But because people are so restricted, I think what we're going to see once we get past this is people are going to be very keen to get out there and do things, whether that be go to a concert, go to some sport, go to the pub and catch up with their friends, go out for a nice meal at a restaurant or a cafe, maybe book a holiday at the beach or something like that. So I do think that people are going to be keen to get back out there and start spending again. I mean, even just me personally, I know not having to pay public transport and for petrol because I'm not going anywhere. I'm saving quite a bit of money at the moment because I don't have anything to spend money on except for food and maybe a little bit of alcohol that I dabble in occasionally. In terms of post-COVID-19, as I said, it's going to take a little while to unwind that stimulus that's currently in place, and that's going to help the recovery. And I think overall, we do have the possibility of a pretty sharp rebound in economic growth, similar to China post the SARS crisis, or similar to what happened to Australia. Not that we actually had a recession, but coming out of the global financial crisis, the rebound was quite strong. So if we look at residential property and what the immediate impacts are, and then potentially what we look like coming out of COVID-19, we've seen a big weakening of auction clearance rates, and most people have decided not to take their properties to auction anymore, but we are still seeing some forging ahead with online auctions. So auctions are not going to be a big feature of the market for the next little while. We have seen search activity on realestate.com.au fall from its peak, and rental search activity is continuing to fall, but for sale search has actually started to increase over the last couple of weeks, and it's actually higher than it was 12 months ago. So that's an interesting little tidbit. Whilst we may not be seeing a lot of people transacting property, I think Australians are still going to be watching the residential property market in particular very closely, doing their research and thinking about maybe their next move once this is all over. We've seen a moderation in new for sale listings coming to the site. However, new rental listings, we've seen a big jump. We believe that that's linked to Airbnb. That product's essentially become unviable at the moment. So people are no longer advertising on Airbnb, but they're looking for someone to rent out those properties for the next 6 to 12 months. And that's seeing a surge in new rental listings, but also that's probably going to be deflationary for rental prices. So the cost of renting is likely to come down. We've got the eviction moratorium in place, but there's kind of a broad moratorium that you can't be evicted, but then the support is coming individually from the states. And to be honest, it's really a bit of a mess. It's very piecemeal, and one state's what they're offering is very different to the others. And to me, I think it's actually a little bit of a mess at the moment. Stimulus and interest rate cuts are making it a very cheap time to buy. And I think the illiquid nature of residential property will actually see it quite attractive. I mean, look how quickly the share market fell. Then it rallied 20%. I think it's falling today. I've stopped looking at the share market, to be honest with you, but it's really all over the place. And some people are just not going to have the appetite for that kind of volatility. And I think that might actually see more investment come back to the residential property market. Also, buy in a downturn, sell in an upturn. But I think immediately, though, the health of everyone's family and hopefully keeping employment is their highest priority. Property is not the same priority that might have been in the past. But once we start to get through this, once there's a light at the end of the tunnel, that's going to shift. And I think the big takeaway is that typically what we see in a downturn is when unemployment starts increasing, that's when we have an impact on the property market. And that's why the federal government's doing everything they can to support the people that do lose their jobs, to encourage businesses to keep people on their books through this period, and also why they've leaned on the banks to give people mortgage holidays for the next 6 months as we get through this. So there's not that level of forced selling. And I think as a result of that, we might see some moderate price falls, but what we're more likely to see is that properties just won't transact for the next little while due to the fact that we are sitting here and as the government says, we're in this hibernation phase for the economy. Post COVID-19, I think there's a good opportunity for a strong recovery. We've got very cheap finance, which is likely to be good for the residential sector. Typically, lower interest rates mean more demand for housing. It's just the fact that this is a much bigger issue than we've seen for 100 years, that it's a health issue and people simply can't go about their lives as they usually would. And there is going to be a level of pent-up demand out there, which is given the likely slowdown in property transaction activity. So we do think that when we come out of this, there will be a lot of demand for housing. I've got some slides here for some other sectors. They're kind of similar, but I think the main one in terms of the developer side is that there might be some issues getting some materials out of China. And I think also there's potentially a drop-off in activity as people assess their investment decisions. Offshore investment, because the borders are closed, is likely to slow quite a bit. But I think if we continue to be relatively successful at containing COVID-19, then I think international investors will, when they're able to, will start looking at Australian property again, and Australia overall is the place to invest quite strongly, because we can contain our borders a bit better than other parts of the world. We do have a free health system. For someone in the US, obviously that would be pretty attractive at the moment, and just a lot of benefits, and our health system is seemingly handling this quite well. I think longer term, we need to look at the housing supply. If development doesn't pick up fairly quickly after this, then we're going to get to the position where we are in undersupply again, and affordability issues will start to rear their ugly head. I'm going to jump ahead a few and have a look at what the government stimulus has been so far. Now, I'm not going to go too deep into this, but we know that there was 3 packages. The first one was 17.6 billion, and at the time that looked quite big, but now it really looks like chump change. And it was about supporting businesses and supporting people that lost their jobs. And then I think it was only a week later, we had the second stimulus package, which was 66.1 billion. And that kind of just expanded on that first package, offering more income support to people that lost their jobs, and more support for businesses to keep people on their books and keep paying them and not shed them. And then I think, again, it was only about a week and a half later, we then had the third stimulus package, which was really all about those JobKeeper payments, whereby for every employee, you were getting $1,500 a fortnight paid to the employer, with the focus on keeping those people on the books to help those employees not have to stand those people down. And that was 130 billion. So for the moment, the federal government's saying that that's enough, but I'm sure they've taken a fairly pragmatic approach to this. And I'm sure if it's not proving to be enough, that they'll look at potentially providing more support for the overall economy and certain sectors, albeit that they're not seemingly wanting to bail out Virgin Airlines at the moment, but obviously take it on a bit of a case-by-case basis. If you then look at the Reserve Bank, They did a few moves. Again, I won't go into too much detail, but we know they cut the cash rate to 0.25%, which is as low as they say it can go. But they also agreed that they're not going to move that cash rate until such time as we're making making a strong move towards full employment, which is below 4.5%, and that they're confident that inflation will be within the 2 to 3% range. And in order to assist with this, they've targeted a yield on the 3-year government bond rate also at 0.25%. And they've chose 3-year government bonds because they're saying they think it will take 3 years to achieve the position where they can start lifting the cash rate again. Now, I'm a little bit skeptical about that because they weren't successfully getting towards full employment before COVID-19, nor had they had inflation within the 2 to 3% range for 4 years. So I actually think it might take a little bit longer than that. But we are seeing them buying Australian government bonds and lowering that borrowing cost for the Australian government at the moment. And they're also offering small and medium businesses extremely low cost funding to go and lend to small and medium businesses. And there's some strong incentives there as well. So if a bank lends to a small or medium business, they're going to have access to an additional $5 of funding at this rate for every $1 they provide to a business. So there's some pretty strong incentives for the lenders to keep lending to small and medium-sized businesses. And then we've also seen moves from the banks, and they're all a bit diverse in terms of what they've actually done, but there's some key similarities. And I think that they are really that they've decreased fixed rate mortgages. Most banks actually haven't shifted variable rate mortgages with the latest cut. They've got deferral options for those affected by COVID-19. They've also increased term deposit rates. So they've given savers a little bit back in terms of this with that cut in interest rates. And the credit agencies and the banks announced that a mortgage deferral is not going to impact on a borrower's credit rating, which is a really good outcome because usually if you take a mortgage holiday, it will impact on your credit rating. And then for small and medium businesses, we've seen quite similar things, a reduction in interest rates for new lending and for overdrafts, financial hardship assistance, and options to defer payments at the moment. So that's kind of the scene as to where we are, but I wanted to look at some of the data and take you through where we're sitting at the moment. So this is some data that we're getting quite regularly, not from the Bureau of Statistics, but from private sector businesses that are providing information. So on the left there, you can see the two charts, the City Mapper Mobility Index, which is basically a measure of how much of the population of a city is moving. And you can see before COVID-19, more than 100% of the city was moving each day, which means people were doing more than one trips on average. Now we're down to, in both Melbourne and Sydney, about 10% of the city moving on any given day. So you can see that, as I said earlier, we just can't go about our lives like we used to, and this really highlights that. The second one, well, we can't go to restaurants anymore, but have a look how rapidly restaurant reservations in Australia fell. They fell from, a typical level to basically nothing in the space of about 2.5 weeks. We've then, in the middle section, got some data from Indeed, which is the Seek website. That's the business that owns Seek, looking at new job postings and total job postings. And you can see compared to where we were a year ago, new job postings on Seek are down 61% and total job postings are down 50%. And you can see again how rapidly that has plunged over the last 2 or 3 weeks. So there's not a lot of businesses out there looking to put more people on at the moment. And on the far right of this chart, we've got confidence and conditions in terms of business confidence from NAB, which was published earlier this week, and then weekly consumer confidence data from ANZ and Roy Morgan. And I think that the key takeaway for both of these is, firstly, the business confidence fell to a record low level, much lower than the GFC. You can see business confidence got to minus 30 points in the GFC. It's sitting at minus 65 points, 66 points, I think, actually, currently. Now, that's only a monthly survey, so you can see it's just dropped dramatically in the space of 1 month. The second chart, the consumer confidence, is a weekly index, and it's actually bounced over the last 2 weeks. It's still at very much recessionary levels, back at levels we saw during the GFC, during the 1991 recession, but it has increased since the federal government announced those JobKeeper payments. So that's helped confidence, but If you look long term, the average confidence is a 112 points. At the moment, we're sitting at about 70 points. So that gives you an idea of just how soft consumer and business confidence is at the moment. So we probably all know that Australia hasn't had a recession for 29 years. And I think the thing we're now looking at is it's looking pretty inevitable that we are going to fall into a recession. It may be questionable about that first quarter of next year, but certainly I think the second quarter is looking like we will see a fairly large fall in economic growth, just because, as I said earlier, a lot of the economy can't operate as it usually has. And I think this is a real challenge because I know in my working life, I've never lived through a recession. The recession started in 1991. I was 10 years old, and a vast majority of the workforce has never lived through a recession. So it is going to be a challenge. And hopefully we can get that V-shaped recovery where we do start to bounce out of it pretty quickly. But that remains to be seen. In terms of inflation, I mentioned before that the Reserve Bank has a target range of 2 to 3%, and they haven't successfully had their measure of underlying inflation between 2 and 3% for 4 years. So again, some of this stimulus will be inflationary, but I'm still not 100% confident that within 3 years, inflation will be comfortably sitting between 2 and 3% because it is probably going to drop a lot over the next few quarters. But as I said earlier, the cost of borrowing has never been lower. I think most lenders, if you want to fix your mortgage rate for the next 3 years, you can get about 2.25%. And variable rates are at historic low levels as well. And again, because the Reserve Bank's flagged that they're going to remain at these levels for the next 3 years at least, or around 3 years, when we do start to come out of it, the cost of borrowing is going to be very low. And I think that is going to encourage an increasing number of people to go and maybe upgrade their home or move into a new property or build their dream home. It could also encourage people that are renting to go out there and get into their own property as well. So that's going to be something interesting to watch over the next little while. We just got the latest labour force data for March today, and it hasn't showed any impact of COVID-19. And the reason for that is the survey that they based this off was actually done earlier in the month than all the shutdowns happened. So we'll probably start to see the impact of this over the next 4 weeks. If we look at what's happened elsewhere in the world, there's been about 8 million people have lost their job in the US, 1 million people lost their job in Canada in the space of 1 month. So if we look at other economic downturns, you can see that the unemployment rate has risen quite sharply, but also employment participation has fallen quite significantly and quite quickly as well. And I think that's likely to be the story about what we'll see over the next few months here in Australia. Again, the JobKeeper payments will help. Federal Treasury said if we didn't have those payments, the unemployment rate would hit 15%. They're expecting that the unemployment rate will hit about 10%. So it will cushion the blow somewhat, but we still haven't had a 10% unemployment rate since coming out of the last recession. So that's still an awful lot of the population that wants to work not being able to work. Looking at some of the other metrics, so the number of houses and units approved for construction, they were already trending lower before COVID-19, but I think we're going to continue to see that trend down over the next few months. I think in terms of developers, they probably won't have the confidence to just go and kick off these projects now, even knowing that it is going to take a while, particularly for apartments. They may not be built for 18 or 24 months. But certainly house construction, I think a lot of that is going to be put on hold over the next little while. And one of the reasons for that is because there's still an awful lot of stock actually under construction, particularly in that unit sector. There's 128,000 units and 58,000 houses under construction at the end of last year. Again, we just got this latest data earlier this week. It is quite time lagged, unfortunately, but you can see that there's still a lot of stock out there under construction. And particularly the unit sector, I think there might be some challenges because if people signed up for these, signed a contract a number of years ago, and then over the next couple of quarters, they get called for settlement on these projects, if they've been stood down for their job or if they've lost their job, it's pretty unlikely that the banks are going to lend to them. So that may cause some more difficulty for the developers out there if people are unable to settle on these units that they've purchased because they've lost their job on the back of COVID-19. And then just moving into some of the housing credit. So housing credit was actually starting to show signs of picking up before COVID-19, but I think we're going to start to see that that shrink again over the next few little period. But what we might actually see is a pickup in business credit. And the reason for that is there are those huge incentives for lenders to be lending to small and medium businesses. So that might actually lead to a pickup in business credit. But I certainly think personal credit and housing credit is going to slow over the next little while. And then we've got the housing finance commitments. So they have been trending higher since the federal election last year it was May, I think. It seems like an eternity ago now. But in February, we actually saw a slight drop in housing finance commitments. And again, this was before COVID-19. I think it's reasonable to expect over the next few months, there's going to be a lot less demand for mortgages. As I said earlier, housing's really a confidence story. If you're feeling confident about your health, your job, you might be willing to go out there and buy a property or sell a property. But if you're concerned about things and you've got low levels of confidence, you're going to be less inclined to do that. So I think we will see housing finance commitments trend lower over the next few months. And retail trade will be the really interesting one. We're getting some private sector data on a weekly basis from the likes of Commonwealth Bank and ANZ. And we know initially that retail trade was held up because there was so much panic buying in the supermarkets. Then we all had to move to home, so we had to go to Officeworks or IKEA or JB Hi-Fi and get the equipment to allow us to do that. But now we're pretty much sitting at home, not doing very much, going out and buying groceries as we need it, maybe getting some food delivered. Even in the last recession, we saw retail trade slow quite a bit. We never saw it go negative. And I think that there's actually a big chance over the next few months that we actually see a contraction in that retail sector because so many businesses are closed and people are largely just not leaving their homes at the moment. And then I think the other one that we really need to consider is what's happening with population growth, because effectively our borders are now shut. If we look at overseas arrivals data and departures data for February, which came out the other day, arrivals from China fell 68% in 1 month. And that's kind of a precursor to what we're going to see from everywhere else in the world, because people aren't allowed into Australia, or if they are, they're largely Australians coming back and having to go into quarantine. So our borders are going to be shut, and we know that population growth is a big driver of demand for the housing market. And whilst I think we're doing very well at containing COVID-19, I think that the challenge for Australia is going to be, once we start getting back to a level of normalcy, we may still not be able to open our borders back up because other countries around the world may not have this contained. I don't think that even if we were to open things up now, we'd be too keen on having anyone come to Australia from New York, given what's unfolding there, or parts of Europe. So whilst our economy might be able to get back up and running, we may actually have to wait a while until international travel starts up again. And that could have an impact on demand for housing, because we know that we have a lot of international students here that come and rent, and we have a lot of people that migrate to Australia because it's a great place to live. If that's not happening, then that will have an impact. And then finally, just the level of debt we have and the value of the assets. So if we look over the long term, you can see that Australian households are fairly highly indebted. You can see, and most of that is driven by housing. The news in the past has been that although we're heavily indebted, the value of those assets was significantly higher than that debt. And look, it's still going to remain that way, but what we're going to see is a fall in household wealth in the value of those assets, because we've seen a big sell-off in the share market. Property prices might start to fall over the next few quarters. And we've also seen superannuation take a big hit. And you can have a look back to the GFC. There was a big decline in the percentage of assets to disposable income, but there was no meaningful decline in the level of debt. And this is the challenge. Whilst we see the value of our assets fall, the value of that debt doesn't deflate at that same rate. So households are going to be feeling less and less wealthy on the back of this. And that will take some time to recover. So that's kind of the summary of everything and where we're at. But in summary, in terms of what this all means, I think that the key point here is that housing and generally property overall is an asset class that really thrives on confidence. And at the moment, consumers are worried, businesses are worried. So I wanted to kind of highlight what the positives are. And they may not be immediate positives, but certainly coming out of this, I think there's a number of positives for the property market. Mortgage rates are the lowest they've ever been, and they've got very little prospect of moving higher for a number of years. We're lucky that property transactions can still occur. Agents just need to be proactive in providing alternatives to how they traditionally sell. And we're seeing that with virtual tours. We're seeing that with some online auction opportunities. In saying that, property transactions can still occur, but I don't think it's going to be the highest priority for people at the moment. There's a huge volume of stimulus in place, and I think that means that we do have the potential for a strong rebound in economic growth post-COVID-19. Banks are still lending to businesses and to people that still have jobs, so that's good news. I think one of the things to think about is how much time people are going to have on their hands over the next few weeks and months while they're sitting at home. And we know that Australians are really obsessed with property, so I think a lot of them are going to spend that time researching and considering their property move. Next property move. As I said earlier, we're actually seeing for sale search activity increasing. I don't necessarily think that's going to translate into sales immediately, but I think once we get past COVID-19, that is going to translate into more sales. The other side of that, I think, to point out as well, is that when you go to work and you're not working from home all day, every day, there's probably things about your property that you don't necessarily like that much, but you can deal with. But now that we lock down in our properties, all those things that are not quite right about where we live are really going to start to grate on us. And again, I think that might drive people to start thinking about building their dream home or looking for another property that better suits their needs. So I think people will spend a lot of time doing research on property, ready to make a move after this. The Australian dollar's fallen, and assuming it remains at low levels, that's going to be stimulatory for exporters longer term. And as I said earlier, the fact that we are actually managing COVID-19 to date, and touch wood, we continue to do that, that might make Australia an even more attractive place for investment. You know, the isolation's always been seen as a bad thing, but that might actually be positive. It's free healthcare, and just that we've done a good job in containing this. So in the short term, despite all of those positives longer term, we still have a lot of global uncertainty. People are losing their jobs, the unemployment's rising. I mean, people are losing their lives as well. Some businesses have already shut, and whilst we hope that they can come back, the reality is that some of those businesses are not going to be able to open back up again. Major projects and investments going to be delayed. Economic growth is going to slow. The International Monetary Fund came out earlier this week and forecast that economic growth is going to fall 6.7% this year and then rebound 6.1% next year. So they think that we can have that V-shaped recovery, but in the short term, there's definitely going to be some pain. And just generally, consumers, again, reiterating this, consumers and businesses are just lacking confidence at the moment. And both measures of those confidence have hit historic lows. So that uncertainty is not a good breeding ground for people to go and make confident investment decisions right at the moment, but that will change. So that's it from me in terms of this. Just before we go to the Q&A, we are going to ask you to fill in the poll that we shared earlier. So I'm just going to stop sharing, and please answer the poll for us.
Hi everyone, so welcome back, and thanks again Cameron for that update. We've got some time now for Q&A, so I think there's been some questions coming through on the Q&A function in the webinar, and I've got some others that some of you guys would have sent through before registering for the webinar, or when you did register. So Cam, I'll just kick in some questions for you. First one I've got for you, Cam, there's a question around, do we feel the government will obviously look to recoup some of the surplus or stimulus rather that have been put in to the market? And if so, do you think the government might look to, increase land tax or that lovely topic of stamp duty that we often talk about?
Look, I think the best way they can recoup this is by growing the economy once we get out of this, and growing it at a fairly rapid rate. If we look at what happened post-World War II, we know that government went into huge levels of debt in World War II. And what they did is they went through an unprecedented boom through the 50s, 60s and 70s. And that the inflation that came with that helped evaporate away that debt. But I think it probably ideologically depends on what governments are in power and what they choose to do. I don't know that it would influence them to touch stamp duty, but they could put income tax rates up at the highest level. Depending on governments of the day, they could look at other forms of taxation. They could look at lifting the GST to 15% from 10%. So although they're saying at the moment the right things, that they're not going to do that, you never know how it's going to look a few years once we get past this.
Thank you, Cam. One of the next questions here. This was particularly interesting. Given Sydney is the third most expensive property market in the world, do you see prices being sustainable at that level going forward? Or do you think it's just more around it being open to a correction than other markets, perhaps?
Oh, look, I think with Sydney, it is very expensive. I don't live in Sydney, and that's one of the reasons why I don't live in Sydney, because it is so expensive. But I think it kind of reflects the fact that people in Australia have been willing to pay those prices. Until you get to a point where people from Australia or people that move here from other parts of the world don't want to go and live in Sydney and aren't prepared to pay those prices, I can't see that it's going to change too much. It's interesting, I was chatting with someone the other day, and it's kind of a bit of a philosophical thing, but I do wonder maybe people coming out of this maybe aren't so obsessed with high property prices. And we do tend to have this notion here in Australia that property prices increasing is a good thing and property prices falling is a bad thing. Perhaps coming out of this, people find other things to focus on and worry a little bit less about the price of their property increasing. And maybe we don't bid up property prices as much as we have in the past, but who knows? I mean, people also revert to their old ways pretty quickly in most situations as well.
Thanks, Cam. Bear with me. Next question here. We've obviously got a budding investor on the call out there, whoever you are. There may be a few of you. Would you recommend now being a good time to buy an investment property as prices are potentially declining, or do you think we should wait for post-corona?
Not investment advice here at all. I don't think I had that disclaimer on my slides, but look, I think, as I said, I think that we're probably just going to see a lot of transaction activity stop. And you're probably, in terms of other downturns like the global financial crisis, at least initially not going to see that level of forced sales activity, because banks are giving people mortgage repayment holidays. So that is going to shield the housing market somewhat. So I think in terms of investment, I think, if you find the right property at the right price, then buy it. I mean, a friend of mine just bought a property today. He signed the contract today, and he was asking me, should I wait off? Should I not? And I said, well, you want to live in this property for the next 20 years. Is an extra couple of tens of thousands of dollars over that long term really going to make that much difference to you? So I think it's your individual situation. I think, as always, there probably will be some bargains to be had out there, but I don't think there's going to be a huge volume of people just in a position where they're forced selling and there's huge discounts available.
Thank you, Cam. There doesn't seem to be any more questions coming through on the Q&A function. So I think everyone out there, thank you for joining. A big thank you to you, Cam, for performing today's update. And for everyone that's joined the call, we will be looking to run further webinars down the line. So stay tuned. You'll either hear from myself or the account management team that looks after your respective client or agency. And this is something that we're really wanting to continue providing updates with. So thanks again for joining. Stay safe out there and sane, particularly for you parents, and look forward to seeing you again soon. All the best.